Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week already, Wednesday morning. Yesterday, the market saw a nice bounce after a while. So there's a fair bit to go in terms of stock-specific coverage, earnings, and, of course, the broader market as well. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning.
Hi, morning, folks. So still no deal. Yeah. And now there are all these headlines coming saying 25%, 15%, 20% will happen. So, yeah. On tenterhooks as far as India is concerned.
Yeah, maybe too much of tariff talk. Maybe we're giving it too much attention. Let it play out by itself. I mean, but the market's clearly a little bit nervous.
Yeah, I mean, we'll see what happens. Interim deal, perhaps. We don't know. But 1st of August is the deadline. Let's just take it from the top, right, in terms of the new stuff that you need to know as we start today's session. So, President Trump essentially said that India may pay between 20 and 25% tariffs, but it is not yet final. That essentially, I think, summarizes what the US president said. And let me just tell you the context of this, right? I mean, the context was that Reuters had reported earlier that a trade deal, I mean, a US-India trade deal may not come until September or October. And Reuters in that same report said that India could get potentially a higher 20 to 25% tariff rate. So, President Trump was asked whether this is true. And the response from him that India may have 20 to 25% tariff, but not yet final, was with regards to that. It was not an open-ended question to which he said, well, 20, 25%. So I think it's an important nuance in that sense. Actually, let's listen in to President Trump saying this, being asked this, and of course responding.
India is preparing to face higher U.S. tariffs between 20 and 25%. Is that what you're tracking, or what do you think the rate will be for India?
They are going to pay 25%.
Yeah, that India is preparing to face higher U.S. tariffs between 20 and 25%.
Yeah, I think so. Look, they're my friends, and he's my friend.
Is the deal with India finalized?
No, it's not.
Okay. So what rate are you expecting?
Well, we're going to see. But India's been a good friend, but India has charged basically more tariffs than almost any other country. You know that, right? Over the years. But now I'm in charge, and you just can't do that. I think the trade deals are working out very well, hopefully for everybody, but for the United States, they're very, very good.
So that's the soundbite. I mean, important to note, it was in response to a number, and he kind of sort of agreed with it. So it was not sort of, organic in terms of that response. We don't have to wait very long. We'll see what really happens. But that's the starting point. Now, U.S. equities were modestly lower yesterday. Of course, there is the FOMC, the Fed meeting tonight. NASDAQ was down about a third. The S&P was down a little bit. The 10-year on the U.S. lost about 9 basis points. There was some data as well, some macro data, which at the margin might have made some difference. But, for example, there were treasury auctions, which actually went very strong. So yields did move about 9, and the 30-year but down about 10, 11 basis points as well. Dollar index up about a quarter. Actually, I think we hit about 99 and then cooled off a little bit, just under it, 98.9 or so. Oil prices continue to spike up. So Brent crude about 4% higher, almost at $73 a barrel. I mean, there's no new news except the fact that President Trump again 2 days back, day before yesterday, basically said that Ukraine-Russia ceasefire deadline is being brought forward by, it got to get done in the next 10, 12 days or so. As I said, FOMC, the Fed decision today, we'll hear from Fed Chair Powell, etc., but most likely to be a non-event. So no change expected. And I think we'll hear some of the same stuff, which is we are waiting to see the full impact of tariffs. Had it not been for tariffs, perhaps rates would have been lower. U.S. jobs data later on Friday, perhaps a lot more important. That's the monthly jobs data. We'll tell you how labor market is holding up. There are Meta earnings later tonight. Apple and Amazon report tomorrow. So you got some big tech earnings coming through as well. On U.S.-China, the U.S. Treasury Secretary Scott Bessent said that they are still discussing the terms of a tariff truce extension. The extent The tariff deadline for negotiation expires on the 12th of August, and they're seeing whether they should sort of extend this further. Most likely, perhaps, that is what will be done. Now, just to tie in the levels here, yesterday, of course, as I said, we got a bounce market. As we were saying, yesterday was looking oversold on many short-term matrices. So we got a bounce, decent bounce. And the good thing was that it was actually a very broad-based move. If you just look at the mid and small cap part of the market, especially the small caps, very long list of volume-led gainers, 20-25 names, and we'll sort of talk about some of these individuals ones later on. So yesterday's low, because we had a bounce, becomes important, that we should not break it. 24,598 is that level. And the resistance is 25,998. We put that level out yesterday as well. Only once the market gets above that, you can say that maybe the decline is complete. That is nothing but the 61.8% retracement of the recent decline from the 24th high to the low that we saw day before yesterday. For the Nifty Bank, the low yesterday was 55,843. So similarly, that becomes the important support, which the Nifty Bank should not go below. And resistance, similarly, is the 61.8%, which is 56,753. So, a bit of a wait and watch. Let's see if you're able to continue with the repair and recovery. But there is this tariff headline as well. We've got to get over that hump as well. GIFT Nifty will give you a quick sense of how we're likely to start. It's a tepid, sideways kind of start, about 30 points lower. Surabhi.
Absolutely. Asian markets are actually fairly range-bound, and it's tariff, 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 trade, trade, trade. That's the only headline for two of the largest economies here, India as well as China, because there's uncertainty around both. U.S. futures, by the way, have perked up. After yesterday's slightly negative session, there's about a 0.25% increase, depending on which U.S. Index you're looking at in the futures market. Now, on the trade part, just to go back to the big headline, the uncertainty around any deal with India. Hear out what U.S. Commerce Secretary Howard Lutnick had to say. He was speaking to CNBC in an interview, and he said that we've done our job in terms of negotiations, and now it's entirely up to the U.S. president.
We put in front of him the deal. He sees the deal, and he decides, do I want to do a deal with India or I don't? And that is up to him. We've done our job. They've made offers, but these countries came to the table slowly from what President Trump was hoping for. But of course, from their perspective, no one's moved as fast. For the rest of the world, we're going to have things done by Friday. And Friday is not that far away. So you should expect, we said, August 1st is the date that we're setting all these rates. And they are off to the races after that.
No deal yet with India. Let's see what happens here. With China, at least the commentary has been a little more positive. But again, over here, trade negotiators have once again reiterated that it's President Trump who holds the key. In fact, Scott Bessent, and I'm quoting him exactly, he says the meetings were very constructive. It's just that we haven't been given the sign-off. President Trump has the final say on all the trade deals. This is with respect to working out that pause, an extension of that 90-day pause in terms of China tariffs. So let's see. So this is the big overhang. Not just this, time and again, there's pharma coming back into the conversation, and we should keep that in mind when we're looking at pharma stocks, because I don't think we've seen the pricing in of a particular tariff risk when it comes to Indian pharma. Yesterday, we had a statement, coming again from Howard Lutnick. He says the president will be coming out with the pharma policy in the next 2 weeks, and he says there will be massive tariffs for companies which are not investing in America. So from an Indian perspective, IT's got its own set of issues. There's banking. Pharma has been holding up really well, but these headlines do not inspire too much confidence. So keep a watch on pharma stocks in the next couple of days as well. Central bank action. We've got, some action in Singapore today. The Monetary Authority of Singapore left rates unchanged, but in their outlook, they're acknowledging that the second half is going to be weaker than the first half. So keep that in mind. The Fed, of course, is expected to remain pat, not expected to change rates at all. 98% probability that there'll be absolutely no cut this time around. But let's watch for if there is any dissent between the voting members. That'll give the market some interesting cues and clues. But amidst all this uncertainty on trade and tariff, guess what? The IMF has increased its growth forecast for India and for the world. Global growth in 2025 is now seen at 3%, which is a 20 basis points improvement from their April forecast. And it's seen at 3.1% in 26, which is a 10 basis points improvement from what they expected in April. So it's not looking bad for India. The growth number expected for this year and next year is 6.4%. The IMF feels that the impact of tariffs is not, at least right now, it's not looking as detrimental as was feared earlier. Very quickly to talk about the flows and the levels here. We've seen some buying from those oversold levels. The Nifty finally had a decent day yesterday, but the flows picture is not encouraging, especially if you're looking at the FPI number. Again, we've got a big sell number, 4,600 crores of selling from FPIs. Good buying from domestic institutions as usual, 6,150 crores nearly of DII buying. Earnings, just want to spot one or two quick stocks. L&T has been a very steady quarter. The top line growth is fairly strong at 15%. The market will say, okay, margins haven't moved up, just under the 10% mark. But all in all, it's fairly decent. Good, order flow as well. And GE Vernova could be a real star to look at today because pristine set of numbers, very, very solid performance in line with the way the stock has run up. So Q1, they've delivered. And finally, keep JSW Steel on your radar as well because there's some relief, sigh of relief coming in for the company and the lenders because the Supreme Court yesterday, actually, it was a rare thing. They heard the review petition and they've agreed to look at a hearing again. And it's going to be an open court hearing when it comes to the Bhushan case. So that's, some positive for JSW as well. So plenty to keep us busy this morning, Nigel.
Well, that's right. But yesterday's bounce was actually encouraging. Yes, we came off oversold levels, but after a while, we're getting some earnings surprises. And you like to see a couple of earnings beats that come in through as well. So yesterday's session was good, but follow-through is going to be important. And if you look at the rollovers picture, well, we have the expiry that will play out, the monthly expiry that will play out tomorrow. And you have both the Nifty as well as the Nifty Bank, the rollovers, if you compare it on D-2 or 2 days before expiry, both are relatively low. So maybe we have plenty more in this series itself, just going by the rollovers data as well. Moving to what the FIs did, well, they added some shorts, no surprises out there. They covered some longs as well. The short positioning at around 87% and more than 1.6 lakh contracts. That's moving to the extreme end. So that was one data point that we highlighted yesterday as well. But if you look at the stock futures, well, out there was some kind of covering that we saw. And there could be some kind of arbitrage as well that's taking place out there, rollovers as well. So difficult to gauge out there, but it appears that at least was on the individual stocks, there was some covering that we saw. Moving to the options data then, and before we do that, just look at this data point. The Nifty on a day-to-day basis is making lower highs. It's also making lower lows. What you would like to see is the Nifty turns this around. Make a higher high, make a higher low. So that's another data point. But as promised, let's go to the options data. And after a while, the bails got taken off from the call writers because they were writing calls aggressively. And that's what's called the PCR to move up to around 0.8. Put writing came back into play. There was a mix of put activity at lower levels as well. And on the upside, you did see that call writers, 24,800, 24,700 call. Well, there was some shedding that we saw at those levels, even the 25,000 calls. So there was some call writers that got a little bit jittery after the bounce we saw yesterday. Though the 24,800 put, there's a mix of activity out there. The premium's around 60 rupees or thereabouts. So, those writers, they'll be hoping that the 24,700 odd level does hold out. So in the near term, we've got a broad range. Yesterday's low becomes a crucial reference point. That's important. And the resistance level comes in at around 25,000 odd. The Nifty Bank, yesterday it showed signs it wants to get past the 50 DMA. On the closing basis, it didn't decisively manage to conquer that. So you'll want the Nifty Bank actually to conquer this 50 DMA and then move to around the 20 DMA. And the other one is Reliance Industries. Yesterday from the day's low actually saw a bit of a recovery. It's pulled back a little bit from the recent peak. But Reliance Industries is some distance away from the 20 as well as the 50 DMA. So you'll want the stock to get back towards that 1,500 odd level. Reliance Industries, the Nifty Bank, they hold the key for the Nifty to bounce back higher from here on.
All right. Well, just quickly, Nigel, thanks for that. Quickly get you some calls, right? This is Prateek Parekh of Novama who says that high valuations and slowing profit of Indian equities are inverting buyer-seller incentives. He says insiders, that is promoters, PEs are on a selling spree, whereas domestic flows are slowing. FI flows are hence now critical, but India's appeal amongst EMs is fading given a high valuation premium and a blunted earnings edge. Essentially, he adds sellers are stimulated while buyers bide their time, and this risks stalling an aging bull market. Even so, he says, policy easing large enough to revive earnings growth could reverse this dynamic. Caution is particularly warranted in small and mid caps given their larger valuation earnings wedge. Okay, we'll have John Stolfers, who's Managing Director and Chief Investment Strategist at Oppenheimer Asset Management. John, great to have you with us here. Thank you very much. Actually, that I don't know if you heard that line from a local brokerage, Novama, saying, well, insiders are selling, local flow momentum is easing a little bit, and FIIs are not exactly all that excited given valuations are high in India, which have always been the case. So where does it leave us, John, in your opinion?
Well, in terms of which market, the S&P 500 or India's market?
India. That was in reference to India.
Related to India's market, we'd have to think when you get to different points. Pardon me? I couldn't hear you.
India. Go on, John. We can hear you clearly.
Related, right now what you've got to consider is markets have to take time to get where they're going. A detour does not necessarily a journey end, is what we always say related to our markets. What we think here, where we are right now, is in a period in which we're beginning to see a change in the world order related to the emerging markets, which markets will be a prominent coming out of a diversification of the emerging markets, as well as from within developed international markets, but it'll be likely more pronounced in the emerging markets. And we expect of the major emerging markets, India, Mexico, Korea will likely be among the major emerging markets to benefit from some of the changes that we will see in terms of global trade. And we think that will be reflected in GDP, and ultimately it will be reflected in revenue and earnings growth.
John, hi, good morning. It's encouraging to hear you say that, because there's no deal yet between India and the US. And the US president yesterday said that he could levy up to 25% tariff, which would be higher than some of our competing Asian economies. What's your sense? The other problem with at least the Indian stock market is that earnings aren't picking up and they're fairly subdued compared to what you said. China seems to be doing better now. Even Korea seems to be doing better. So can that keep foreign investors away longer?
Well, I think, anytime that you see a slowing in earnings growth, naturally you're going to find investors are going to begin, some nervous investors, skeptics, and bears will likely take some profits at those particular points. But we've got to say, if you're looking for the trends intermediate to longer term, and I mean 2, 3, 4 years out, which is really what you need to look at, it would seem to us that the new order that we're envisioning is very likely to be realized. And some of this is a result, first of all, of the great financial crisis, followed by the pandemic, and then the disorder in terms of the global supply chain. I think from a perception of the tariff talks that are going on right now, these are highly complex situations to be worked out, and it is quite natural that there will be some volatility that will come into the markets and questioning in terms of where we will likely arrive to as a result of negotiations. But we think that where we are headed, because of the innovation that the United States offers, as well as the potential for manufacturing in other countries outside China. This is not to say that we believe that China will not be still remain a substantial player, but it will not be any longer all roads lead to China when it comes to the global supply chain, but yet it will be shared among countries. From a practical standpoint, it makes all the sense in the world. And usually things work out to genuinely rivers will flow where they're going to flow at the points of least resistance.
All right. Hi, John. Good to see you in this morning. Very quickly, before we let you go, the S&P 500 actually has been quite resilient, but you believe that maybe it has more in store before the end of this year. You're calling for another 10% move from here on. So tell us, what's the target on the S&P 500? And also the dollar index, that's weakened a lot in the last few months. Are you calling for a bottoming out of the dollar index?
Well, let's start with the S&P 500. We came into this year with a 7,100 target for the S&P 500, and we put that in last December. By a little bit after April 2nd, we lowered our target to 5,950. because the markets had gone through a correction and then almost a bear market at one point. We were down 18.9% from February 19 from the peak to a low on April 8th. From that point, we've rallied, we've regained, we're back at new highs. And we do believe that the process that is beginning to be seen, whether it's with the agreements that have so far been more than sketched out, but still not absolutely locked in stone, but the ones that we've seen with Japan, as well as the most recent one over the weekend with the EU, we think these are pointing the way to the tariffs risks that have been felt by the market, and the concerns about earnings will likely be ameliorated enough to see gains of around 10, 11% from here to the end of the year. And that is in process what we've seen. We've seen a broadening of the S&P 500 rally. If you look at it right now, industrials is the best performing sector on a year-to-date basis,
Right.
and also from the lows. This would tell us that
Indeed.
the market is definitely broadening. Related to the dollar last year, based on the Bloomberg Dollar Index, as I recall, was up about 8%. The dollar this year has fallen, about my recollection, at the depth down around 10%. We saw some strengthening in the dollar.
Right.
That has come back. That is likely going to settle, but still at a point it'll bottom out, but at a position where we expect the dollar will remain the reserve currency of the world. If you consider all currencies being dirty shirts in a basket of dirty shirts, the U.S. tends to be the cleanest dirty shirt, and ultimately, it is the dollar is the reserve currency of the world because of the transparency, governance, and innovation the economy has.
If the S&P 500 does indeed do that 10%, 10 to 11%, move up from here, it'll be a great year for U.S. equities once again. Then, good to have you on the show, John. Look forward to the next one. We'll have a longer conversation on India next time you're around. Thanks for joining in. Well, with that, let's move on and talk about the other interactions that are lined up on the show today. At 8:35, we'll have the management of Greenply Industries joining in on the Q1 numbers. Lots of corporate conversations today. At 9 a.m., we'll be talking with the management of Arvind Fashions, talk about how their first quarter has been and their outlook for the year. Remember, the company is also going through a management change. At 9:20, we have Saurabh Mukherjee of Marcellus Investment Managers joining in. He's a market master of the day. Figure out what their stance is on the market now. Mazgaon Dock, weak start to the year. Those weak first quarter numbers, is that a one-off? Is there more? Mr. Biju George will detail out that performance at 9:30 a.m. After that, we have the management of the International Gemological Institute, IGI, joining in at 9:40. At 9:50, we'll have Venkatraman Narayan and Joseph Anantaraju of Happiest Mind Technologies, one of the few IT stocks that had a positive reaction after the quarterly earnings. So we'll talk about that. Towards the end of the show, Lata will be in conversation with Rajneesh Karnatak of Bank of India on the bank's first quarter performance.
All right, time to slip into a short break. You've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I give you a sneak peek. L&T, JSW Steel, GE Vernova, GMR Airports, Pyramil and Allied Blenders will be reacting to positive news flow. NTPC, Bank of India, Star Health and Tilak Nagar Industries could be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. So there's some caution across Asian markets, but there's no major slide or anything like that. The Hong Kong market is down about 0.3%. Japan has finally turned positive. 2 days of profit taking in Japan after they got their deal and we had that monster rally. Now there's some green back on the Japanese screens as well. Australian markets are holding up. Mainland China is holding up. But what are we doing? Let's get the implied open. It was down about 30 points last we checked, 40 points lower right now. So brace for maybe another slightly weak opening. Lots of stocks in focus as always. So let's straight away get to our top list to watch this morning, guys. Good morning to all of you. Let's kick it off with the big earnings. Vivek, how's L&T?
Well, good morning, L&T. Very strong set of numbers. Hardly much to complain about. A healthy start to FY26. Order inflow is something that is positively surprised the street, and the execution too is quite strong. The only blip is the margin performance, but the company has not changed the guidance, implying that margin trajectory over the next 3 quarters will be quite robust. So revenues higher by 15.5%, a slight beat, EBITDA higher by 12.5%, EBITDA margins on the consolidated level coming in at 9.9% versus 10.2%, and net profit higher by close to 30%. Now, the EBITDA margin in the core services business is at 7.6%, largely flattish on a year-on-year basis. The EBITDA margin trajectory for the year has been maintained in the range of 8.3 to 8.5. If you're talking about the order inflow for the order gone by in the core business, it's up 41% on a year-on-year basis at 77,000 crore, which is the key positive takeaway as far as the results are concerned. One key development that the company did mention as far as the conference call was concerned for the media, number one, the prospect pipeline maintained at 14.8 trillion rupees. And secondly, the company has said that they're open to opportunities as far as divestment of Nabha Power Plant is concerned.
40% growth in order book, Vivek, right? I mean, that is incredible. We used to wonder a few years ago, 10-15%, will it come, not come? And here you've got a much larger base, very, very strong accretion in order book. Let's just stay with the old economy in that sense. NTPC, Vivek, take us through those as well.
Well, that's right. NTPC, well, this particular quarter was expected to be slightly subdued given the fact that you actually saw slightly muted power demand in the entire quarter. On the back of that, the gross generation trends was something that was slightly muted. But having a look at the numbers themselves, looking at the revenues down 4.2% on a year-on-year basis, EBITDA down 17.5%, margins coming at 24.1% versus 28%, and profitability higher by 5.8%, aided by higher other income. Now, the gross generation, one key metric to track, is almost down 7% on a year-on-year basis, and the commercial generation was down 6.8%. Now, one key positive development that the company has highlighted, and this was something that the street was looking forward to, especially in terms of visibility, is the strong pipeline that they have given, especially when it comes to nuclear power generation. So that is something that the street will look forward to. More details are awaited when the company holds its analyst call later.
Okay, thanks for that, Vivek. Well, there's some relief coming in from the Supreme Court for JSW Steel. Ashmit joins us to run us through that piece. Ashmit?
Well, big relief coming in for JSW Steel as well as for the lenders in the Bhushan Power and Steel case. The Supreme Court agreeing to hear their review petition in an open court. Now, let's add context to that. Why is that significant? Bear in mind that in the month of May is when the Supreme Court had scrapped the entire resolution plan for 19,700 crore rupees altogether, had sent shockwaves across the IBC space, had sent the clock back by as many as 5 years. And it's after that that a review petition was filed by JSW Steel by the lenders. Now, as is the course, review petitions are decided within the judges' chambers. They don't hear any arguments. It's done within closed doors. And therefore, an application had also been made by both JSW Steel as well as for the lenders, asking for an open court hearing, which would allow them an opportunity to impress upon the court why it's important to overturn this May judgment by the Supreme Court. That relief has been granted. Just yesterday, the Supreme Court passed the order issuing notice, agreeing to hear this petition, issuing notice on the review petition, saying that the Supreme Court will be taking this up on July 31st at 3 p.m. And that's when JSW Steel, as well as the lenders, will be able to make their case. JSW Steel, as a part of its petition, has been arguing that they've managed to script a turnaround for Bhushan Power and Steel. Sales have doubled, revenue has tripled, and that's the argument they'll be leading with on July 31st when the Supreme Court takes up this review petition in the Bhushan Power and Steel insolvency case.
Okay, all right, Ashwin, thanks very much. So indeed, some relief coming in over there, and that all-important hearing will begin in open court again. Let's move on now and talk about some more numbers. Vamakshi is looking at GE, Vernova, TND. And I guess as the stock kept rallying, at least the numbers seem to be keeping up with those expectations, Vamakshi.
Well, absolutely. So we're not just keeping up with the expectations, in fact, beating them. In fact, last night when I was calculating the numbers, I had to actually double check because it was such a big beat as far as consensus estimates are concerned. Now, the revenue for the company grew by almost 39% on a year-on-year basis, and this was largely driven by exports. They were up almost 78%. The domestic market sales were also up in double digits, up almost 21% on a year-on-year basis. Now, when we look at the cost of goods sold, however, it grew at a slower pace, and therefore we saw an improvement in margins of almost 814 basis points, which is quite massive for a capital good company. Gross profit margins now stood at 48.4%. Look at the EBITDA margin as well. That is too seeing an expansion of almost 1,000 basis points, and it stood at 29.1%. This is one of the highest margins among some of its peers, and resultantly the EBITDA has more than doubled to 388 crores, and the net profit too is more than doubling at almost 291 crores. This is almost a 57% beat as compared to what the street was expecting. The ordering activity though was quite robust. It was more or less in line with what Nomura was expecting. Order inflow was up almost 57%, and the order book stood at 12,960 crores. This is slightly lower than what Nuvama was expecting, but nevertheless a good set of numbers for GE Vernova.
Okay, thanks for that, Vama. Well, going back to Vivek. Vivek, tell us about GMR Airports.
Well, GMR Airports is a robust operational performance by the company. Remember, despite multiple headwinds that the company faced in the quarter gone by, aided by number one, strong traffic movement itself, and number two, aided by the fact that there has been a tariff uptick as far as Delhi Airport is concerned. You've actually seen the revenues higher by 34% on a year-on-year basis, EBITDA higher by 45%, margins coming in very strong, 40.7 versus 37.4% on a year-on-year basis. On the bottom line, there is a loss. However, when you're talking about what the company has said as far as the operational performance is concerned, number one, they've highlighted the fact that the tariff uptick in Delhi has improved the financial profile. Along with that, there is a chance that there could be a further hike as far as tariff is concerned, given that there is a review underway. Now, when you're talking about the bottom line, there is an exceptional expense of 42 crore, which the company says going forward will not be there. So overall, a strong operational performance from GMR Airports this time around.
Okay, all right. Piramal Enterprises and Bank of India, the next two we want to focus on, which is financials in focus. Gaurav has got those. Gaurav, morning.
Well, yes, when we talk about Piramal Enterprise, good set of numbers is what we saw. Although AUM growth was at around 22%, the company has guided around 25% growth for FY26. And even when we look at the numbers, net interest income that increased almost by 25%. Now operating profit is up more than 50% because of the other income, and total profit is also up almost by 50%. Now, when we look at the asset quality, there also we saw a bit of improvement. The credit cost that has gone down almost by 40 basis points. Although management has said that there is some stress in the used car and MSME segment. Let's not forget that the drag from their legacy book is actually going, and that is the reason why they have given a PAT guidance of around 1,300 to 1,500 crores, which is positive. And after that, we also saw brokerages like Citi, Jefferies, CLSA, all of them, they have upped the target price for the company. When we talk about Bank of India, a weak set of number in terms of net interest margins because they have gone down to 2.55%. Now, management has guided around 2.5 to 2.6% of the NIMs. But let's also look at the numbers. Net interest income that declined almost by 3%. Now, operating profit that increased by 9%, but that was because of the other income, and profits, they have increased by 32% on a year-on-year basis, but that translates into ROA of just around 0.82%, and management is also guiding for ROA of around just 0.9% for the year, which is actually a little bit of negative, and that is something which can be taken in a negative way, and that is the reason why we are watching out on Bank of India as well.
Okay, all right, got it, Gaurav. Thanks very much for that. In fact, we'll be speaking with the management of Bank of India, 10:15. They will talk about their first quarter performance and the outlook ahead for the rest of the year. Mr. Rajneesh Karnatak joining in over the next couple of hours. Let's get back to more earnings then. Yash joining in on Star Health. Was it a healthy set, Yash?
Well, not a healthy set, certainly. The numbers have been weak, though the premium numbers, the net earned premium, has been stronger than what the street was anticipating. To speak about specific numbers, NEP, net earned premium, that grew by about 12% in the first quarter. As I said, it's a beat as per what street was anticipating. Underwriting profit, that has reduced significantly, and that's a big negative, coming in at about 72 crore versus about 140 crore. The street was anticipating a number of 108 crore. Operating profit, that has also reduced, coming in at about 249 crore versus 312 crore. The street was anticipating a number of 233 crore. Finally, PAT, that has also reduced about 17-18%, so that's another negative. And the final one is the combined ratio, coming in at about 102.16 versus 99.14, so that has deteriorated. The street was anticipating a number of 99.93, but it's come in at over 100, so that's a big negative for the company.
Okay, all right. That's Star Health for you, the largest private sector health insurer out there. Let's get Mangalam in on Allied Blenders and Tilaknagar Industries. Mangalam, good morning.
Good morning. So good numbers coming in from Allied Blenders. In fact, all the three triggers of the company are playing out. Sales mix is improving. That's leading to a good revenue growth led by volumes. Gross margins are improving. And at the same time, the profits are further getting boosted by lower finance costs. What does all of this mean in terms of numbers? 22% jump in the revenue. Gross margin improved by 500 basis points. EBITDA margin improved by close to around 300 basis points. We have the net profit, which is quadrupled from 11 crores all the way up to 55 crores. Further boosted by lower finance costs as well. Volume growth of 17%, realizations per case increased by 6%. And remember, now Prestige and above accounts for nearly 56% of their revenue. So see some green on Allied Blenders. On the other hand, Tilak Nagar Industries, we have the details of the fundraise that have come by. The company's announced nearly 2,300 crore of fundraise via preferential issue. The only fly in the ointment here, the issue price is at 382 rupees, which is a 25% discount to the current market price. So maybe the stock has run ahead of the price at which the issue was made. Warrants have been issued to Small Cap World Fund Inc. There is Abacus, there is Singularity, Ramesh has the money. So a bunch of investors out there. And they will be utilized, obviously, to buy Imperial Blue, which the company acquired for 4,150 crore rupees. But the good part is that because fundraise has come in at around 2,300 crore rupees, implied debt addition on the back of this deal is close to sub 2,000 crore rupees, which could be a positive. So for starters, the stock opens in the red because of the sharp discount, but thereafter, the street looks at possibilities going ahead post this consolidation. So maybe we see some recovery.
Okay, absolutely. We'll watch out for Tilak Nagar. And that was, of course, the big break that Nigel told us about. Big acquisition coming in for the company. Let's quickly recap then all the stocks in focus today. The ones that have positive news flow today are L&T, JSW Steel, GE Vernova T&D, GMR Airports, Piramal Enterprises and Allied Blenders. Stocks with negative news flow or earnings would be NTPC, Bank of India, Star Health and Tilak Nagar Industries. Okay, that's our equity list. It's time to talk commodities. And remember, along with all the earnings issues and trade issues, another overhang for the equity market today is the sharp jump in crude oil prices. You've got Manisha in with the latest. Manisha, morning, 3% up on oil overnight. What's happening?
Oh, well, absolutely. Surbhi, this week actually has been quite bullish. Monday was 2% of gain. Tuesday was 3% of gain. And with that now, for the week, if you look at the 5 last trading sessions, we are up by 6%. For the month of July, the crude oil prices are up by 8%, and we are trading at a 5-week highs right now. Well, improving globe trade relations, as you see more and more those trade agreement announcements coming in, has been supportive for the crude oil prices. But 2 other things which have led the prices higher. One is, of course, the statements coming in from U.S. after Trump saying that Russia has now just about 10 days to agree on a ceasefire or face sanctions. After this statement, there was a statement from the U.S. Treasury Secretary Bessent saying that with the U.S. secondary tariff legislation or sanctions on Russia oil, China could also be looking at higher tariffs if Beijing continues to buy Russian oil. So there are various statements coming in, and that is where you have the premium for the prices as well. Apart from that, OPEC and allies also are discussing to pause further production hike from the month of October. But what the markets will watch out for now is the Fed policy meeting today. You have Bank of Japan monetary policy meeting on Thursday. The China PMI data also comes in on Thursday. And amidst all of that, dollar index is trading at a 1-month highs. And even with that, the crude oil prices are trading in the positive, telling you that it is looking strong on charts.
Okay, all right, Manisha, thank you very much for that. So that's commodities in focus. Oil seen a bit of a bounce over the last 2 sessions or so. We'll take a quick commercial break here. We're going to come back with our first corporate on the show. Greenply Industries reported earnings. And we speak with Mr. Manoj Tulsian of the company on their earnings and outlook ahead.
Welcome back. Well, let's focus on Greenply. The past quarter's numbers a little bit subdued, but what's the way ahead? We're joined by Manoj Tulsian, the joint MD and CEO of the company. Hi, Mr. Tulsian. Good morning. Always a pleasure to have you on the show. Well, it appears in the plywood business, this time around is a little bit softish. Could you tell us what is the volume target you have on the plywood business? What is the margin outlook? So volumes, margins, and have you lost any market share? Because there's no growth this quarter.
So, morning, Nigel. It's always a pleasure to be there on your show. In terms of plywood, for the full year, we are given a guidance of a 10% volume growth and also a double-digit margin. But yes, I agree with you. The first quarter has been subdued. But when I look at the lower sales in housing by almost 20% across all the metros, I think possibly it's a decent job done. There is a pressure on liquidity in the market, and June was quite tepid, possibly early monsoon, and maybe a mix of also lower housing sales.
But you believe that things will recover from here on? Your plywood business, you'll do 10% revenue growth at least. Is that possible?
I think so. If we just wait and watch quarter two, July has been good for sure. And, I told you also earlier that with the BIS implementation across the panel division in the month of August, in H2 will look much better for sure. Yes, but I think, we need some more traction on the housing sales side because quarter one was quite disappointing when you look at the numbers.
Indeed. And margins recover to double digits as well?
Well, if we are able to do around, even 7 or 8% volume growth during the year with around 10 or 11% revenue growth, I'm sure that we'll touch double-digit margin because we'll get a lot of operating leverage also, which will play.
Mr. Tulsian, what did you mean? Some liquidity issues there in the market?
Well, so, Prashant, what has been happening, which we have been seeing for last 2 or 3 quarters, that we are not able to get our receivables we are recovered on time. And to that extent that, some of our dealers and the channel partner who have never failed in terms of paying on time, also this time could not pay on time in the month of June. That clearly shows that somewhere there is a liquidity issue into the market,
Should we tie that in with what we've been hearing from, some finance companies, etc. we speak to, or that's not it's a specific issue here with green ply?
I don't think. I know we have checked with other building material organizations also, and we find that they are also facing similar challenge. So somewhere, liquidity is stuck, and I think RBI has taken enough measures. Everybody is saying from quarter two there will be a lot of money which will come back to the market. So I think possibly that will resolve the issue. It's a short-term issue.
Mr. Tulsian, what is the overall, as we stand right now, what is the overall FY26 revenue growth estimate that you can tell us? It is that 10-15%?
Yeah, so, a two-line of business, plywood and MDF. MDF, if you really see, we have done around 7.5% volume growth and 10% plus revenue growth. So our target for both the, division of business was that we'll grow in double digit. MDF will maintain a healthy margin of around 16% for the full year. We are already ahead of that. We are around 17.5% in quarter one. And plywood, we said that almost from 8% last year, we will move to double-digit margin this year. First quarter, we have not been able to pull that up. But I'm very sure that by the year end, we will move to double-digit margin and as well as double-digit growth in plywood also in terms of revenue.
All right, Mr. Tulsian, got that. Encouraging to hear that July has been better.
Yes,
couple of other pointers. Debt repayment target for this year, what is it likely to be? And working capital days got stretched a little bit. Maybe it's because of the liquidity issues and the likes. Where does it stabilize at?
So, debt right now, we are at around 500 plus. But by the end of quarter two and quarter three, this will come down significantly. As you rightly said, one account of better collection. The other is also on the MDF. We are taking a planned shutdown in the month of August. It's a expansion of capacity by almost 200 CBM per day.
Okay.
And we built up the inventory, so that will get also liquidated in the month of September. So by the end of quarter two and quarter three, we'll continue to reduce our overall debt exposure. And I think by the year end, we should be somewhere around 400 to 425 against 534 right now.
And working capital days comes down to back to 45, 50 days?
Well, 45 days in plywood looks to be difficult, but, we are almost at around 59 days or something right now. But I think 51, 52 days for sure will bring it down. So that will also pump in extra money into our balance sheet.
And net profit for the year will be around 120 crores odd? Last few years, you've been doing 90 to 100 crores. Is that a probable number we can work with going by everything you're saying?
Well, I'm looking at both the business separately, and then we also have a hardware business, so which will still have some drag during this year. So I'm just looking at individual businesses, And whatever it adds up to, you guys understand the numbers very well. So whatever you're saying, numbers must be correct.
Okay, let's see whether or not you can do that. Next time I'll push you a little bit more once we're at the halfway mark, but 120 to 130 crores net profit is what some brokerage estimates are working with. It's doable. All right. Thanks a lot for that, Mr. Tulsian. Well, we'll slip into the short break. We have Deven Choksey or DR Choksey Finserv waiting for us on the other side.
Okay, welcome back. There's about 7 minutes to go for the pre-open session. Just want to make a quick mention of the GIFT Nifty is at 55 points lower. Keep an eye out on Indian pharmaceutical names, Dr. Reddy's, Cipla, some of the GLP-1 hopefuls within Indian pharmaceutical companies. And the reason I'm saying this is because Novo Nordisk, which is a Danish company, the stock was down 22% last night. And it was down because they put out a muted sales forecast for the full year, partly driven by pressure that they're seeing on the weight loss segment, which is GLP-1. Semaglutide, different brands. For Novo, it is Viyogi. The other companies, there's Ozempic, etc., etc. It's a very large category globally. Perhaps even larger than the cardio drugs like Lipitor, etc. GLP-1 as a category of drugs will be huge. Some estimates put it at $100 billion. But the concern at the margin is that there will be too much competition too quickly coming into this space. So keep an eye out on the DRLs of the world, and of course a couple of others as well. But even fill-finish companies, OneSource and a couple of others who have spoken publicly about how they're setting up large capacities to cater to the demand which may come from GLP-1 drugs. So just wanted to put that up for you. Deven Choksey is with us with a quick check on things and what he's making of it. Deven, good morning. Good to have you here. I don't know if you have a comment on this, the pharma space on the back of the Novo guidance cut last night. If you do, please weigh in. Otherwise, I think the big story, of course, is L&T's very strong accretion in its order book.
Yes, Prashant. Good morning. I think the visibility in the order book is something significant for L&T. And I think this quarter's result has also been an outstanding one for a long period of time. I think L&T hasn't produced this kind of result. I think that's a confirmation that larger the order book size, and the ability to deliver is giving them the better handle on the markets in the business. I would imagine that they continue to hold the size of the order books, visibility for at least 2.5 to 3 years, next 5 years as well, because of the amount of demand for the construction, including from the UAE segment that they are having, is quite a significant one. So that's where probably one could possibly argue for a steady to better growth going forward as against the muted growth in the past.
Okay, I think what we'll do, Deven, is take a quick commercial break here. We'll come right back and continue this conversation on a bunch of other stocks as well with Deven. Stay tuned. Coming up.
Welcome back. So just about 9 a.m. now, we'll start getting the pre-open rates any second. Deven is with us. Deven, hi, good morning. We've got two decent earnings, good numbers coming in from both GE, Vernova T&D and L&T, both in the infrastructure and old economy capital goods space. Do you like either of the stocks?
Yeah, certainly. Good morning. Well, L&T, as I said, looks promising from a point of view that it is creating a very large visibility of order execution for next 2.5 to 3 years at current levels. The more important part is they have stabilized on the margin, which was not the case in the past. And that's where I believe that going forward, if this strategy works for the company on managing the costs along with the higher growth, probably the results are likely to be relatively better compared to what we have seen in the past. So remain cautiously optimistic about the prospects going forward. Of course, I think in some quarters when the market gives you the price correction, that would be a better time to buy into the stock.
Devin, it's been largely a subdued, lackluster earnings season. Not too many big hits, but pick out something for us. Last 4-5 days, I mean, any company, mid cap, large cap, small cap, where you were very pleasantly surprised with the numbers, and if it makes sense to buy any stock.
Well, I think the importantly among the finance companies, the Bajaj Finance and Bajaj Housing Finance, both these companies compared to the peers have shown at least, I think, 2.5 to 3 times higher rate of growth. And that is what is more important to understand. Of course, we have been calculating that possibility. But importantly, I think when the peers are facing the pressure in the marketplace, these two companies have been showing relatively better performance. Maybe their ability to deliver the loan faster to the end customer and process it, I think, in the best interest. Probably, I think giving them the advantage, which no other players are, I think, enjoying at this point of time. So we look forward to, I think, such differentiators in the marketplace, I think, while building the portfolios.
Another space they were in, which was buzzing and how, was chemicals, right? And we are, this is a kind of new story, not that new also, but it seems like China is pulling back seriously on a lot of capacities. Because, I mean, there's just too much price competition within China, right? And chemicals is one area which people like Morgan Stanley, etc., highlighted. I mean, we put out that note, Morgan Stanley double upgrading their view on Tata Chemicals. But it was not just Tata Chemicals. The stocks will come up on your screen. Tata Chem was up sharply, Sharda Cropchem. Some of them, of course, are based on individual result reaction as well. Deepak Fertilizer, Zuari, Granules, Dhanuka. Of course, I mean, a small name like Paradeep, of course, on the back of earnings. But that entire pack and more was buzzing with lots of vigor yesterday. Any thoughts, anything you like here, Devin?
In the specialty chemical space, I think many companies have actually shown respectively, I think, a higher performance, largely because of two reasons. One, on the input side, I think the cost factor has remained under control. And either because of the China factor or, I think, overall improvement in the conditions. I think some of these companies have actually started showing relatively higher amount of offtake and the revenue. So both the volume-led growth as well as revenue-led growth is coming up, for price-led growth is coming up for these companies in current times. In my viewpoint, I think if I have to put across one summary, I think I believe that given the situation when the cost is under control and the demand situation is on a buoyant side, probably this period of next 4 to 6 quarters would be, I think, a super quarters for, I think, most of the chemical companies, and particularly the specialty chemical companies who are actually supplying to even the pharma segment apart from agrochemical segment. So we remain, I think, relatively more positive on their prospects as far as those companies are concerned.
Okay, Devin, we'll leave it there. Quick chat, but useful as always. Appreciate you joining us here on CNBC-TV18. Let's get some trades out of the way. Sudarshan and Mitesh are with us with a quick check. Gentlemen, good morning. Good to have both of you here. Will the bounce last, and what should you do if you get a flattish open? That's the question to both of you, gentlemen. Mitesh, you go first.
So, my sense is that, Prashant, the bounce may not last too much, but we are not getting any, strong directional bias. Like earlier, we were, looking at least a test of 24,900. And then if it breaks a test of 24,500, 550, we got a low of around 24,598. But broadly, the Nifty, which now will be approaching those medium-term supports around this 24,550 zone, there is no sign of continuation on the downside, neither there is a sign of reversal. So most likely outcome, in this kind of a scenario is that you might see a range develop. My sense is 24,550 to about 25,200, 250 on the upside. And therefore, you would want to deploy this range strategy, which means that you try and sell near the upper end of the range, get into put spreads or buy put options or even sell futures, and try to take profits on the lower end of the range and then explore long opportunities.
Sudarshan, what about you? Good morning.
Yeah, good morning. Well, the Nifty is still under pressure, and we are going to have these days like the ones we saw yesterday. The markets don't go down or don't go up in a straight line. So in spite of the fact that we had a very decent rally yesterday, I would expect the markets to be a sell-on rally trade till proved otherwise. The trade really works like this.
You look to sell the Nifty on rallies and look to buy good quality stocks. So essentially, you also create a hedge of some kind and go into the outperformers.
Okay, all right. Got that point, gentlemen. Good morning. Let's discuss stocks for the morning then. Mitesh, what's on your list?
Good morning. So I have a mix of buys and sells, slightly more biased towards long sides because the stock patterns are positive. So Asian Paints, I think, gave a very good reversal yesterday. Buy here with a stop below 23.79. Look for targets in the range of 24.45.50. Similar, very strong price and volume reversal on Geofinance. So that's a buy as well. Keep a stop below 315 half. Look for a 335 kind of a first target. A buy on Syngene, it was called earlier as well, but even now can be bought with a stop at 702 for a trading target of 730 plus. And one sell call, that's Petronet. Would recommend selling here with a stop at 297 half for targets of 282.
All right, got that. Sudarshan, let's come to your stock list as well. Is it buys, sells, or is it a mix?
No, it's just a buy list, as I explained. Where you buy stocks and try to sell the Nifty. L&T is a buying opportunity. You've already talked about it. Buy with a stop under 34.20. Syngene is also on my list. It's a buy with a stop under 695. And then another stock you've already spoken about. So it's really a common ground today. Tata Chemicals is a buy with a stop under 980. Tata Chemicals and L&T are essentially not just intraday or short-term trades. They're really positional investing ideas also. And Zydus Life is a buy with a stop under 975. So all four buying ideas.
Okay, all right. Gentlemen, thank you very much for that, Mitesh and Sudarshan, with those specific trades coming through. And of course, useful to get that overall view on markets as well. Let's get at the standout brokerage report. Nimish is with us. Nimish, good morning.
Hi, morning, Prashant. So today's standout is on M&M Financials. An interesting upgrade from Citigroup. So they've upgraded the stock to a buy from neutral and they've retained a target price of 292. They believe that the risk reward is turning favorable, backed by fundamental changes, and those includes that the rural demand is quite strong compared to the urban demand, so that's going to help M&M Financial. The growth potential exists in tractors, SME, as well as pre-owned vehicles. So they see a business momentum there. Third, the asset quality is improving has improved in Q1, and that trend is likely to continue in future as well. And fourth, even in the worst case, they expect the book value impact of not more than 5 to 6%. So on back of all this, and at current valuations of close to 1 time price to book, the risk reward is favorable, and hence an upgrade to a buy to M&M Financials from Citigroup, and they've retained a target price of 292.
Okay, all right, got it. Thanks very much for that, Nimesh. We'll keep M&M Financial on our radar for sure. Let's quickly get to some earnings conversations then. Talk about Arvind Fashions. The company came out with the numbers, and it's been a good start to the year. Kulin Lalbhai, Vice Chairman and Non-Executive Director at Arvind Fashions, is with us to take a couple of questions. Kulin, hi, great to have you on. Of course, it's been a pretty steady start, and for the sake of our viewers, I'll just quickly recap the numbers. Revenue growth, almost 16% up. Margins steady at around 12%, and your profit has grown substantially as well. But before we talk about the numbers, Kulin, I want to talk about the change of guard. You have Ms. Amisha Jain taking over, and the market got very excited with that because of her pedigree and what all she brings to the table. She's been with Levi's, global brands like Nike earlier. So what's the growth mandate you've given to her in an environment where we talk about sluggish consumer demand? Tell us what you're seeing on ground and what can we expect slightly more medium term from the change of leadership.
I think we are very excited about welcoming Amisha to the company. I think this is a part of our succession planning exercise. So as we look at the next 10 years of value creation, we were looking for a leader who could energize the brand portfolio further and also, create a stronger growth momentum for the company in times to come. I think the company has done incredibly well, to re-energize and pivot on profitability. And we are very well set now as a platform to truly make these brands the largest and most aspirational. And as we move along, I think what you will see in the fashion business model is beyond the core tenets of creating exceptional retail product and branding. We'll have to become very strong in capabilities of the future, where digital, AI, quick responsive supply chain, these are all going to become very critical skills to win in the future. So I think the next 5 years should see us further lean in and accelerate the growth of this portfolio and also make our business model robust further compared to even where it is today.
So, Kulin, I mean, you've given for this year, I think the overall guidance is between 12 to 15% top line growth. But if I extrapolate this a little bit, let's talk about a 2 to 3 year view. Is there a possibility of perhaps even going within the vicinity of 20%? And how does the change in the channel mix, how does that impact your plans? Because there's so much buying that's happening online, even when it comes to high ticket items, whether it's sneakers or luxury for that matter.
Actually, we believe that for this business model, 15% sort of growth rate would be a very, very healthy growth rate on organic growth, because I mean, that's a very large growth on the base we have of 5,000 crores. And as a company, we are very focused on OCF generation, right? We are not just focused on top line generation. So along with growth in top line, we want to continuously improve our bottom line percentages. And therefore, the cash flow growth that we want over the next 5 years is the main focus area for the company. So we still retain this sort of 12 to 15% band. Hopefully, we can push it towards 15 as all our growth drivers come in place consistently. But I think a 15% growth rate, but with a much higher growth in EBITDA and OCF is what we would look to deliver. I think this quarter has been a very heartening quarter for us. 16% growth is the highest growth we have printed in the last 3 years. And it's a function of all of the hard work that has gone over the last couple of years in energizing the brands. We have increased our marketing, we've differentiated our products, bold retail. So all of that is now coming together and we're seeing the build-up of the momentum.
Kulin, hi, morning. With Amisha coming on, would you want to leave us with I mean, I don't know if there's a big target on the board for Amisha that you've put up. Is there one you can share with us?
We will leave the board targets to the board conversations. But what do we do want to do, as I mentioned, is create consistent accelerated growth and a further revitalization of the business model. I mean, directionally, that's what you can expect from us.
So there is one, or you won't, you're not telling us that. So, obviously, thank you very much, Kulin. Short conversation today. Appreciate you joining us and good to speak with you here on CNBC-TV18. That's Arvind Fashion. Stock's done very well, 543. We are hitting market open in about 2 minutes' time. And we will just take stock of how some of the stuff is closed in the pre-open session. Let's just put up L&T and just take a look at where the stock is at. 3.5%, 4%. So that's a big mover this morning on the back of very strong accretion to order book as it's come through. Arvind Fashions, of course, we just sort of highlighted, but a bunch of others as well through the course of the next 1.5 hours that we'll be speaking with. Look at Mazgaon Dock in terms of how the numbers have come through. Gale, perhaps another one which we should put up for you. And a few others as well. I don't think there's a bit of a bump, 70-odd points, but as Mitesh was saying, perhaps it's about stocks rather than the index. Both Mitesh and Sudarshan made that point earlier. So we will keep with it, keep with some of the names. Actually, no, except L&T, no large reactions that I can spot. We've got some of these names at the bottom of the screen as well, which are coming through. First sort of rates which will start to appear in a bit from now, and we will look at those. Chemicals is this area which, of course, was buzzing yesterday, and some of these stocks were flying. We'll see if there is any follow-through as well. So that's a non-earnings related, slightly a broader topic, tailwind in that sense. Nifty is up to begin the day. We are above the 25,000 mark. That's good to note. A close above 25,000, and then I think people will start to believe that maybe this decline is behind us. This broader decline from the highs is behind us. For now, it is above 25. Just under 25 actually now. The Nifty Bank is absolutely flat, nothing on it to begin the session. Mid-cap index, flattish. The small-cap index will come up on your screen, give you a quick sense of how we are starting. And we will pick up from there. Broader markets was the story yesterday, and out of the gates, straight out of the gates, you got 3:1 in terms of advances to decline ratio. So this is a very, very strong kind of market breadth. Although we'll give it 5-10 minutes for it to settle down, more measured picture then. What do we have? More down than up, like yesterday. 30 down and about 20 up. That's the overall sense of things. You got L&T on one corner and Tata Motors on the other end of the spectrum to begin the session. Surabhi.
Concern. Tata Motors, if they indeed go for this big Italian acquisition, as reports are indicating, it's a huge one. 4.5 billion is what the set price would be. And this is the largest they've done since Chorus. The market's a little nervous about how this could play out, given the size and the scale and the numbers involved. So 3% down on Tata Motors. Dr. Reddy's is also lower. Let's watch for some other stocks like Cipla, slightly lower there. Remember the negative news in pharma? One is on what we've heard from Novo Nordisk on semaglutide, scaling down their guidance for the year on that all-important GLP-1 drug. And the other is this constant talk of higher tariffs in the US. So pharma under a bit of pressure. If you talk about what else is moving in the market, on the upside, there's L&T, which is good news. 3%. Good quarter coming in for the company. JSW gets relief from the Supreme Court. Supreme Court has agreed for, hearing on the Bhushan matter. 1.5% up on that stock as well. Some gains on BEL, Tata Steel, Bharti Airtel. This is where the leadership is. Some big stocks like TCS and HDFC Bank, for the time being, they're keeping their head above water. So let's see how that plays out. Tata Motors is the one to look at. It's down about 3.5%. We'll get you more on this story. By the way, Asian Paints, yesterday's excitement after Q1 numbers, it's fizzling out this morning. Stocks down 1.5% as we speak. Net 30 higher on the Nifty. Nigel.
Well, a lot of stocks actually from the broader markets are buzzing around. Bliss, GVS Pharma, it's a small company, 1,800 crore company. They came out with their numbers. The street seems to be liking that. Top line growth, I think, of around 10% approximately, and margins clocking around 20%. So I think that's why the street does like that. The net profit as well has come substantially high. I'm not sure whether or not there is a big other income actually in that. So I think that's why that net profit number is looking much higher. But that's one of the top volume gainers. Operational performance okay, and net profit bumped up by a big other income. The other ones that are moving around, Gateway Distriparks, that's been a rank underperformer, right, over the last few years. But yesterday's numbers were encouraging, and the street likes it. So after a bounce yesterday, we're seeing a further bounce today. We'll have the management that will be joining on later on in the during the course of the day as well, during midday. So that's up and about. IGI, we'll be having the management shortly who will be joining in. That as well is up close to around 6% in today's trading session. Northern Arc, we had Digant Arya, who joined on Finding Alpha a few sessions ago. He was saying that this is one of the companies that's actually very, very well placed. It's already had a big run. It continues to move up close to around 5% as we speak. And Jaiswal Neco, the stock is up close to around 7%. There was no clarification that came in yesterday with regard to the ARC 5 crores pending sale. But for the time being, the street believes that most of that is over. We'll have to look through the day with regard to if there is a disclosure or not that's coming out there. For the time being, very, very large volumes, but the disclosure from the ARC will be important because last count, there was close to around 5 crore shares that were pending. Tata Motors, the street believes they're going to be looking to, choose something that's too large. So that's why, on the fears of some inorganic growth, that stock is down close to 3%, one of the top losers today. So that's about all the movers. The Nifty, by the way, is up close to around 40 points, and at least we made a higher high, which is encouraging.
Well, let's see if it holds and we're able to sort of grab on and keep at it by the end of the day. Well, we'll have more sort of stock spotting as we kind of go along. But let me welcome in Saurabh Mukherjee, who is with us. He's founder of Marcellus Investments. Saurabh, great to have you on the program. Thanks very much. Good morning. It's been a while since we had you on the spot. So let me ask you to outline your views on where we stand as you see things. I think, markets, of course, have, how should I put it, done well over the last couple of years, maybe entering a bit of a slow patch. Earnings, of course, once in a while you get into this slow patch as well, and I think that's where we are at. Where does that leave Marcellus and you in terms of your thinking on what's ahead? Saurabh.
I think the good news for India, right? The good news for India, I think, is that in the context of what's been a remarkable bull market over the last 5 years, large cap and specifically large cap quality, I think, is pretty reasonably valued. So the kind of things that we tend to like, e.g. HDFC Bank, is sensibly valued. And even though the economy has entered a cyclical downturn over the last 5-6 quarters, and even though earnings growth has slowed down to a crawl, I'm not that stressed about large cap quality valuations. Value investing stocks or cheaper stocks with questionable fundamentals have had a tremendous 5 years.
And as the economy loses steam, typically the market tends to rotate back to volatility. I think that piece gives me a lot of hope that our style of investing is gradually coming back again into vogue. This year so far has been good for Marcellus. Where I worry about the Indian market is small and mid cap. I think the valuations make no sense to me. Why the small cap index has doubled in 3 years without any fundamental support makes no sense. And what really worries me is the intensity and strength of flows into small and mid cap AUMs. The amount of money they're taking in, the lack of earnings growth, the giddiness of valuation. I think that patch of the Indian market worries me, not just as a market participant. I also have macroeconomic concerns. I think middle class India is putting too much money in small and mid caps. And if there is a big correction there, that'll have macro implications for the country as well.
Saurabh, could you just lay out what the Marcellus flagship kind of portfolio looks like right now? You mentioned HDFC Bank briefly. What else makes up? I mean,
large positions. So much the same actually, Prashant. We don't change the large positions that much. So HDFC Bank for many years has been a large position. Obviously, when it flatlined for 3 years, we suffered. But then it's a high class institution. As asset quality tanks in India, HDFC Bank is obviously coming to the fore. Divi's Lab has been for now, I think, nearly 7-8 years a big position. It did well during COVID, then pulled back in the year after COVID. It's done well again, remains a large position. Trent, 3 years ago, we built it into a large position, remains a large position. We're seeing the slowdown in consumption. Obviously, Trent is taking its share of pain from the consumption slowdown. I think a previous speaker, Kulil Lalbhaiji, was also speaking about it. Trent is also seeing its share of consumption slowdown. But I think structurally, we see Trent as far better placed as most other apparel retailers in our country. Asian Paints, for many years, a large position, remains a large position. We remain reasonably sanguine about the Birla piece. I know the Birla empire is mighty and they're putting in a lot of money and effort, but I don't see the competitive intensity playing out in the marketplace as much as perhaps many people watching this show do. Asian Paints' bigger challenge will be the consumption slowdown, like everybody else. That company's volume growth is also muted because of the consumption slowdown. And then moving on beyond these names, companies that we've built more larger positions in more recent years, say Eicher Motors, 2 years ago we built that, remains a healthy position for us. Pidilite, long-standing Marcellus favorite. So it's much the same. New entrants, I would say Eicher Motors at the newer end. And there are some mid-caps, small and mid-caps, where we are beginning to nibble. But I have to confess, in small and mid-caps, the valuations are so punchy that we worry about building large positions just yet.
Hi, Saurabh. Good to have you on the show after a while. You want to name a few of them, though? I've gone through the large caps, the traditional favorites, HDFC Bank, Asian Paints. Eicher Motors is something that you've added. Divi's Laboratory as well. You've spoken about it in the past. From the mid and small caps, one name if you could share with us.
So look, I mean, the overall pharma space, right? I believe the pharma space will do well. It's not just Divi's and outsourcing. That obviously is a part. I think outsourcing will come to India. I think the America-India trade deal will fructify. I'm not in the camp which says America will hammer India with pharma tariffs. It makes no logical sense for them to do so. So as the pharma space burgeons, as both outsourced manufacturing and Indian formulation makers do reasonably well, there'll be a whole bunch of ancillaries who will do well on the back of that. And that's where we're focusing, Nigel. That's where we're focusing a big part of our research attention. And to that end, I think 2 years ago, we built a small position in Aequitas. This is a supplier of raw materials, supplier of intermediates to firms like Divi's. And I think as Indian APIs gain market share in the global context, suppliers to Indian APIs, firms like Aequitas should benefit. I know it's expensive. It was reasonably inexpensive when we bought it 2.5 years ago, just soon after its IPO, but it's become eye-wateringly expensive. But that being said, many of the intermediates players in India are growing their business at 30-40%. Which is what's leading the whole world to say that shouldn't we be loading up on these type of specialty chemical companies.
Which is the company? Sorry, missed that. The company's name, Saurabh, just to clear the air.
So this is a company that changed its name. It used to be called something else. It's now called ACUITAS. ACUITAS.
Okay. Saurabh, hi. It's almost like deja vu speaking to you after so long, and yet some of your top holdings still remain, right? So you've kept the faith.
Same old.
Yeah. Absolutely. The Pidilites of the world, HDFC Bank, Divis. This could be a conversation, I think, 3 years back as well. But, I want to get your thoughts in a little more on the consumer piece, because there's a lot of disruption that's going on. Now, while you've kept the faith on trend, the market's been, volatile, saying they're not growing at 50% and now it's 20%. At the same time, what are you thinking about the platform guys? Because they're showing profitability, they're showing the burn, reducing, and consumption patterns have been changing. So just tell us a little more. Like you used to have Page Industries. It was a big conviction stock for you guys. I don't know if you paired off that. What about QSR? Tell us what else you're liking in consumption, and where have you taken profits or, paired positions?
So look, I think let's start with the platform piece, right? So on the platform side of things, InfoEdge is how we chose 3 years ago. We chose to build a position in InfoEdge, and because InfoEdge holds stakes in Zomato, Blinkit, or now it's called Eternal, right? InfoEdge holds a large stake in Eternal. We are able to get exposure to that. I'm not so sure that directly we'll be investing in these platforms, because it sort of runs contrary to the house style of focusing on well-established players with strong cash flows. But we can see that somebody, maybe two companies, will build multi-sector QCOM platforms. At this juncture, via our InfoEdge stake, we think Eternal seems to be the front runner, but it could be Eternal and one more. We don't quite have the skills to go and load up on the platforms directly. With regards to Page, we exited around 3 years ago now. I'm glad to see the company is doing well in the recent quarters. We exited because in the post-COVID, during COVID, for obvious reasons, we all sat at home and bought plenty of leisure wear and shorts and t-shirts and so on. And Page had a terrific run. In the post-COVID aftermath, as the excessive spend on Page's products tapered off, and there was some comparative new entry, Page suffered. And 3 years ago, I think we exited the position. It's doing well. We'll keep tabs on it, but at the moment there is no Page in the Marcellus portfolio.
Okay.
On that company, Equitas, I think Nigel was asking. So it used to be called Ami Organics. It's now called Equitas. They changed their name recently, and that's why it might not be a familiar name. We built that position a couple of years ago, I was saying.
Okay, so Ami, that was to the earlier point of Nigel, that Ami Organics was the chemicals play that Marcellus liked, and now the name has changed to Equitas. On the platform companies, Saurabh, while you're not playing them directly, I mean, you do still have InfoEdge, right? Anything else in consumption? Any new ideas that have managed to pass your filters?
No, nothing on consumption. My reading is we are heading for a consumption downturn. That's why I'm holding off both on talking up more consumption stocks, and Marcellus genuinely is holding off building new consumption positions. So the RBI data is very, very clear. Net household financial savings is at a 50-year low, right? Savings in India running at very low levels. I think Indian household savings will rise over the next 2 to 3 years. As that does so, I think there will be pressure on consumption. A, given punchy valuations. B, given impending pressure on consumption, we are holding off building more consumption names, because we worry about that space. If you ask me, if anything, right, we will try to see, can we find more plays on private capex? I think the single best piece of news I've heard for many months was the not just the L&T results, but within the L&T results, the announcement that a big Indian company has given L&T a big BTG project, boiler turbine generator project. I think private capex will make a comeback over the next 2 to 3 years. And what we are trying to do is scope out where should we put money in private capex. I stress again, I'm talking about private capex, not government capex. Corporate India, for the first time in its history, has net cash. I think we will see a private capex a bull run over the next 2 to 3 years, and we're trying to figure out whereabouts in that we should position ourselves. I think the consumption piece, we are in a downturn on consumption. I expect it to continue for several quarters.
Okay, that I think that stock that Saurabh is talking about, it's Acutas, ACUTAAS Chemicals.
That's right, yeah. Thank you. Thanks, Prashant.
It's not ACQ. I think we should change that.
ACU, you got this name in the ticker, right? So used to be
that is, I think, what
changed their name.
A little bit of confusion there, but there you go. I think we have it now. acute.
This space, I think, will do well. I think India, America, pharma, specialty cans, so pharma API will be a central part of the deal. America is very, very keen to reduce dependence on China for API. As that happens, ancillary suppliers such as this, and there'll be many more ancillary suppliers such as this, should benefit because they will get a slice of global action via firms like Divi's Lab and Loris Labs and so on.
Got it. A great conversation, Saurabh, and we'll chat again in greater detail on some of these themes. But by the way, I liked how you said we don't have the skills to invest in such a nice way to. What was it? I think it was the quick commerce company. Surabhi, you asked, right?
Yeah, because they don't pass muster.
It's a nice one. Thanks very much, Saurabh. Good to have you back.
Yeah, but that's an interesting pivot at Marcellus as well. Now they're looking at private sector capex. And speaking of capex and the heavy industries or the old economy space, let's pivot to one important set of earnings. And the company on our radar is Mazagon Dock. Now, Mazagon Dock had a weak start to the year. The higher expenses impacted profitability quite a bit. Margins saw a sharp fall as well. Let's talk about this and the outlook for the rest of the year. We have with us Mr. Biju George, Director Shipbuilding at Mazagon Dock Shipbuilders. Mr. George, thank you very much for joining in. So that's been the market's concern as well, right? Your subcontracting expenses were up 9%. Project expenses, moved up 3x. Provisions were much higher. Can you just explain to us if this is just a one-quarter hit and what should be the normal expectation on margins for the coming quarters and for the year as a whole on EBITDA as well as EBITDA margins?
Yeah, so there has been a dip in the EBITDA this quarter. This is primarily owing to the fact that we had to make some conservative provisions for our ongoing projects where we have encountered a steep hike in the subcontracting rates as well as similar kind of hike in the equipment cost. These are all driven by boom of shipbuilding in the country as well as globally because the equipment manufacturers have already moved into a seller's market. So when we contracted these orders, it was a buyer's market. So therefore, that shift in the scenario. So we have given a kind of provisioning, and that is the reason why it has taken a hit. And there is no further anticipated provisioning in the quarters to come. So that kind of pressure is not anticipated in the. Yes.
So, sir, can you give us a trajectory to work with as margins start to normalize, maybe Q2 onwards? What will the recovery path look like? And for the year as a whole, what is a steady state margin expectation that your shareholders can have?
Yeah, so the margins like the year before, we hope to maintain same. The 15 to 20% margin is what we expect. Now, what is happening for the next couple of quarters, we would be on a path of recovery because our ONGC projects are seasonal. During monsoon, we are unable to execute it in offshore. So once the monsoon period is over, so the next 3 quarters, we expect a pickup of revenue from the ONGC projects as well.
All right. Hi, sir. Good morning. Good to see you. Ben, what about growth for the year? 8 to 10% is doable?
Yeah. So that's what I can give as guidance because currently our residual order book is approximately 30,000 crores. We are executing it. So this particular quarter we had to provision, as I said, that is the reason for this hit. But, we are on the road to recover.
The current order book you said is 50,000 crores?
No, around 29,900.
29,000. Okay, ballpark 30,000 crores. But there are a couple of other large orders that we were talking about the last time around, sir, that you were expecting. Could you tell us which project we could look at closing out this year in terms of an order inflow? And what could the quantum be?
Yeah, so as far as the future projects is concerned, we are serious contenders for 3 additional submarines and 6 75I submarines. So these are at the advanced stage of negotiations. We are awaiting government decision, which hopefully would be in our favor, and we expect that some kind of orders are going to materialize this financial year itself.
So just confirming, I believe in the investor call you've given a number. I'm just reconfirming the number that with all of these additional submarine contracts, your order book could touch 1,25,000 crores this year itself. Is that right?
See, that is, I would say, slightly speculative because we do not know which order is going to materialize and in what sequence. So if everything comes, of course, it will touch that figure. But at this point in time, I won't be able to commit that this is going to happen and this financial year it's going to happen.
Okay, so then let's work with where you have realistic timelines for bid awards to come through. So if not 1 lakh, what should we work with? I mean, you were at about, I think, 30,000 roughly is the order book position right now. Should we expect the order book to double? Would that be a more realistic assumption?
That would be realistic, but the order in hand is 30,000. In the next 4-5 years, it will have to be liquidated. By 29, the current order book has to be liquidated. So it will get progressively liquidated. And at the same time, we are in the process of, these are the anticipated orders. And we are also looking at warship projects also, apart from the submarines. That is the 7 follow-on 17 Bravo project. That is a frigate program. Then the next generation destroyers are also there. We are serious contenders for that as well.
Sir, and so that's on the order book front. Just give us a sense of the execution. Like for this quarter, you've had double-digit top-line growth. Expecting to do more of that? 15% revenue growth for this year?
Yeah, so in the current order book itself, we would be able to sustain that. So if new projects also come, the revenue recognition or booking will happen only after 2 years down the line, because after signing the contract for realization of the value of production on ground, it will take 2 years.
Okay, I guess we're done with the
all right. Just one more quick question, sir. In terms of exports, what is what is the potential that you're looking at in the years to come? It's still reasonably smallish, but that is some potential out there. So if you could tell us where do you see this number headed? And also in terms of breakup, repairs and, what is the segmental breakup, the ideal mix you'd like for the business on the whole, exports and business breakup?
Yeah, so we'll have to put it into 3 buckets. One is shipbuilding and the new construction for domestic consumption, like for Indian Navy and for Indian Coast Guard, ONGC, etc. Secondly is the export, and thirdly is the refit and repairs. So coming to the export, right now we have already contracted 6 ships for a Danish client that is progressing. And there is a lot of export potential. We are looking for further orders. We are in the process of discussion, but nothing, as of yet, nothing is crystallized. And coming to the repair vertical, we already have a repair vertical, but for doing in-house repairs, we have a dedicated dock for repairs where we are doing relatively small vessels around 120 meters long. That's what we can take in a dry docks. And that is clocking a revenue of approximately 100 to 120 crores per year. That's a minuscule revenue compared to our total revenues concerned.
All right.
And I would also like to mention that you're already aware we are acquiring controlling stakes in Colombo Dockyard, where their main business vertical is ship repairs. So on the ship repairs front, that revenue also will get consolidated into our portfolio as when Colombo Dockyard would become a subsidiary company to Mazagon Dock.
Okay, we wish you all the best of luck, sir. Thank you very much for joining us. Good speaking with you here on CNBC-TV18. We, by the way, had a really extensive, long interview with the shipping secretary a couple of weeks back. And lots of what you're saying, essentially, in terms of the pipeline of orders, etc., secretary had sort of confirmed to us as well. Thanks once again. We have the next company ready with us. We have Taimas Printer, Managing Director and CEO, and Ishwar Iyer, Chief Financial Officer at the International Gemological Institute, IGI, now joining us. Gentlemen, great to have both of you here. Thank you very much for your time.
Thank you.
Always a pleasure.
Hi, good to see you.
Let's just, revenues are up 16%, EBITDA is up 37%, profits are up 67%, and volumes are up 21%. So these are very, very healthy numbers. Margins are up some 900 basis points on a year-on-year basis. And you're saying these will get better as you go forward.
We'll at least sustain this for sure.
Okay.
Yeah.
Is there a specific sort of guidance you're working with? I think we're about 58% here.
Yeah, we spoke in the beginning of the year. I think the guidance was a 15-20% revenue growth for this year. With an EBITDA margin, we had given a range of around 57 to 64. We delivered 64 in quarter one. We are at 58 this quarter. I think we should meet the guidance that we'd given at the beginning of the year.
What happened in the quarter, if you can just sort of run us through a little bit of, highlights. Volume growth has also been very solid.
Yes.
In our earlier two conversations, at least, we've asked you about whether, on the lab-grown side, things are going to look... will that kind of dampen enthusiasm for your kind of business, competition, etc.? Doesn't look like it's made any difference.
See, lab-grown is a new disruptor. And it's come in after 100 years. Okay, so obviously there is a lot of disruption happening in the industry. IGI is a neutral body, certifying body. We are independent of all biases, any preferences, nothing. We believe in giving the analysis of a gemstone or a diamond to the consumer. It's the consumer's right to know what he or she is buying. So from that point of view, while there have been different opinions among the labs, we stand neutral. So we say we will certify the diamonds as per the 4 C's, which is an age-old criteria which has been used to analyze the diamonds.
Right. Okay. Between sort of lab-grown and natural diamonds, in terms of certification revenue, what is the split right now?
I think it's between 50. It's remained more or less the same. I think 55-45. That's been the split.
There was the one concern was that as the lab-grown diamonds become really widespread, and there's no... Will the need for certification itself go down over a period of time?
Let me put it this way. If you want to buy a natural diamond, you need IGI certification to know that it is not a lab-grown.
I see.
And if you buy a lab-grown diamond, you need IGI certification to know that it is not a piece of glass.
Okay.
Simple as that.
No, but just on the certification controversy, because the GIA, the Gemological Institute of America, it started there, right? They said that we're not going to give the 4C certification for lab-grown, but you are giving the 4Cs.
We are giving the 4Cs.
In terms of just having certification market share for lab-grown, are you bigger than GIA or do they certify?
Where lab-grown is concerned, we are much bigger than GIA. In fact, we lead the global markets in lab-grown.
So it doesn't impact your volumes at all?
Because we have adapted the lab-grown. Initially, we started lab-grown certification in 2005. The US continent is the first continent, the Western country is accepted the lab-growns. Last year, the bridals were over 50%, in lab-growns. So we don't see that. What we believe in is giving transparency and awareness to the consumer.
Absolutely. And your volumes are intact, so no change.
And they speak for itself.
All right. Good to have you all gentlemen in the studio. A couple of questions. You use a couple of adjectives. One is that y'all are neutral. It has been a disruptor. For someone like me, it's an opportunity, actually, because otherwise you'll never give the lovely ladies at home natural diamonds. So at least now this lab-grown could be a potential opportunity. That for a later time. Let's talk about business for y'all. In terms of certification, I think per certificate for lab-grown, it's ballpark $15. And I think for natural, it's twice of that, around $30.
Around 40.
Around $40 or thereabouts, a little more than half.
That's right.
So 2x is what it is for natural diamonds. Could you tell us what is the margin difference between the two?
See, I think we've addressed this in the past as well. While from
The profitability aspect, I don't think we touched upon. We touched upon the realization.
The margin as well. I think while natural diamond, because of the price at which they sell finally, is a high margin business from a unit economic standpoint. But the volume throughput that we get from the lab grown is what therefore accelerates the revenue and EBITDA performance for us. And that's what is being seen in the last 3-4 quarters in our results. I think the volume throughput that comes from lab grown is enabling us to therefore, really move that into the EBITDA or the PAT. From an operating leverage standpoint.
Right.
I think the mix of both is therefore helping us. Sorry.
You want to give a margin difference though, and also now lab-grown jewelry is something that's a smaller part of the business, but I guess it has tremendous potential. So just wanted the margin difference between natural lab-grown diamonds and lab-grown jewelry.
We don't measure it by each segment because the grader who does natural diamond today does lab-grown as well. So we don't have that sort of a distinction within our MIS tracking or whatever in terms of what could be the differential margins there. But as I mentioned, the throughput that comes through volume on lab grown is therefore accelerating the revenue performance and also the EBITDA performance.
Absolute number.
These $40 which Nigel mentioned, that's the average realization per report.
Right. Yes, natural.
Okay. And when we say volumes, that is the number of stones that you're certifying.
Yes, that's correct.
So essentially, I mean, it'll be. Would you say the ASP or the average realization over a period of time you'll be able to sort of hold this at these levels?
I think, what's happened over the last 3-4 quarters, which we discussed again, I think we took a slight pricing correction in Q2 last year. Was that we've seen a lot of price stability in the business. And thanks to that, if you look at the sequential ARPU as well or the ASP, I think the average realization is slowly inching up because we're starting to cycle those price drops of last year. So I think we should be able to hold that for this year.
Okay, and just the way the market is moving, I'm assuming volumes will move more and more towards lab grown.
What happens is lab grown is an affordable luxury.
Exactly.
So more and more millennials and the Gen Zs are adopting it. They have other expenses to take care of. At the same time, they can satisfy the desire to own a diamond. That's the most important criteria. I mean, the percentage of...
You brought a smile to Nigel's face.
He's a Gen Z. He's a Gen Z.
At least it's affordable, Prashant.
I have already messaged the important people at home. Don't worry about it. Conversation has been relayed.
Pressure.
It is a diamond.
It is.
There is no difference.
Absolutely. Whether it's found under a rock or whether it's lab grown, it always looks good.
So volumes will keep going up. You think volumes will keep going up?
Of course.
Whereas ASPs...
As the awareness grows, the volume's going up. It's a question of awareness. I mean, the Indian community, is more conservative. But they are also slowly realizing the economics of buying a diamond. And once we Indians...
Take to something, then the volumes hit the roof.
So, it's a exponential thing actually right now.
Nigel actually touched
what we are seeing is we are in the business of certification and authentication.
And but the other point what Surbhi said, we take to it, but we also drive prices lower. Eventually. You think?
On the wholesale level, there is a lot of competition. On the retail level, the prices are holding solid. It is the brand value that a brand can command. So at the retail level,
what is the drop in wholesale pricing, and what do you see ahead?
Currently, it is steady at around $70 to $100.
$100 close
$100
a carat.
$100 a carat, which is decent.
More pressure ahead. Wholesale
pressure is always there. Pressure is always there, but you have to do a different kind of awareness creation. It's not only a price point. You have to create a market, and lab grown has the ability to do it.
Because the men will talk about market value and resale opportunity. That's why I was asking. Go on, Nigel.
One number, if I can ask you before you'll go, looking at your past record, your profit number effectively doubles in every 2.5 to 3 years. Currently, you're going at a run rate where this year you'll be doing close to around 600 crores ballpark, going by what you've done at the half-year mark. Next 2 years, you can be more than 1,000 crores of net profit. Is that the aspiration?
I think,
aspiration is definitely there.
But to what Tehmasp just mentioned, I think while the US market has adopted lab growns, I think India, China are the next probably growth drivers. And you touched upon lab grown jewelry. That could be the big propeller of growth for us. So hopefully things going to plan. We don't see any reason why we shouldn't double.
All right.
where we are today.
That's interesting. So 1,000 crores net profit is achievable. Thanks a lot, gentlemen, for joining in.
Thank you.
I think
Thank you very much.
I think I put myself in the spot by making
Well done.
the lovely ladies at home are waiting for that. So let's see how I can work out that. But thanks a lot.
Thanks for
joining in.
having us here. Thank
Well,
you.
time to slip into a short break. On the other side, we'll have the management of Happiest Minds. Stay with us.
Welcome back. You're with us on Corporate Radar. Let's continue with more corporate conversations. And Happiest Minds is the next company that we're speaking with. The company reported a strong set of numbers for the first quarter. There was healthy revenue growth coming through along with margin expansion. Rima caught up with the company's MD, Venkatraman Narayanan, and co-chairman and CEO Joseph Anantaraju. And she began by asking them about the quarter and how they see growth shaping up in the future.
We had stated late last year when we gave our Q4 results that we would be looking to doing double-digit growth in constant currency. The first quarter of this year, we have done 2.3. If you keep this trend and build on the strengths, we should be there for the year. The good thing is, the trend up in our margin profile. We have got back to the 17.8, 18% operating margin kind of a number from the slight dip that we saw in the last quarter. So if you look at year-over-year growth or a quarter-over-quarter growth, whether it is EBITDA or operating margin, there has been significant growth to underpin that statement that we made. So guidance, I would say we're not holding it out as a guidance, but the estimate for us is double-digit growth and margins in the range of 20 to 22%. But one point I would like to highlight in the call is that our generative AI business, which I have been consistently referring to, has been taking in investments for the last 4-5 quarters, has broken even operationally. So we have just made about 24 lakhs of operating margin on. If you can look at our segmental results, that comes out clearly. But that break even is a significant uptick from the investment phase that we were in the last 4 or 5 quarters. We continue to be investing in that business because it has to come to a profitability level of equivalent or higher than PDAs and IMSs. So we have a slightly a road to that or a plan to reaching that, upping our efficiency in terms of utilization, picking up from 40 last year to about 55, should go up all the way to 75 doing billable projects. And that's the way forward for us to turn that, investment into a payback kind of a situation. New sales into which we had made investments is also starting to pay fruit. And that's also seen in the financials. So yes, efficiencies that we are seeing in the business, improvement and turnaround is what should hopefully pay for, the pay increases and foreign currency volatility and further investment that we hope to make in Artha banking and other platforms that are in the works for us.
So just to complete the point on generative AI, and congratulations on it breaking even. So today, generative AI is 2.4% of your revenues, which compares with 2.1% prior quarter. When do you think you will be able to get, operational profits from generative AI at par with the company average? Can it happen as soon as, say, Q4, the end of this fiscal year, Q4 of FY26? What's the roadmap? And even in terms of revenue contribution from Gen AI, when can it hit double digit? I mean, what pace is it growing at?
Generative AI to the similar operating margins as the other business would happen in FY27 because we have just 3 quarters left. And I see the EBITDA increasing sequentially. So FY27 is when we're expecting it to get to the same levels. And then after that, hopefully be at a higher level. And, as far as the contribution of Gen AI is concerned, I think we need to look at it from the lens of direct revenues and pull-through revenues. Because for most of our Gen AI projects, there's a need to figure out the right source of data to get the data into one data lake or a customer data platform. And then there's integration involved, there's UX element involved. Typically the flow, the pull-through is around 1:2. We expect that in the next 3 years, generative AI should get to around $25 million in revenue from the $5 million that we expect this year. But the more interesting thing is the pull-through revenue and the ability to differentiate out in the market.
Joseph, that $1 billion revenue target, which you had set by FY31, last time you said that, that's been delayed and you will provide a revised timeline. So now what is the new goalpost for the company or the milestones? When can we hit $1 billion?
Sure. So we've been constantly, looking at this number given all the movements in the market, because when we set this as part of our vision in 2021, 2022, the market dynamics were a little different. Having said that, if you look at our, CAGR, CAGR over the last 4 years, from 2021, it's been at 28.5%. To get to $1 billion by FY31, we need to do 22%. So it is a feasible number. But we're keeping a very close look at the number, the inorganic growth, the organic growth. And, when we feel that we need to make a statement, we would get back. But as of now, I think we're holding on to that FY31 goalpost, but keeping a very close watch on our quarter-on-quarter, year-on-year growth and market conditions.
Venkat, the margin guidance of 20 to 22% by FY26, is that for EBIT or is that for EBITDA?
It's for EBITDA. And
so you're already there, because this quarter you did 21.6, I think.
21.4 for this quarter. Yeah. Okay. So that's what we want to maintain and improve on through the efficiencies that are there in the system. Yeah.
Quickly, what drove the margin improvement on a quarter-on-quarter basis?
One is the organic business growth, 2.3%. That's a healthy growth, in our business. That plus there was some benefit that we got from foreign currency, but not as much as what we thought we would. The third is, generative AI pulling in that break-even number. And also, there are a few of our existing projects which have grown nicely. If you look at our segmental results, you will see that existing business, there was a little bit of, relaxation on the holdback on the so-called discretionary expense. So that all of that helped us in, keeping the same cost structure, and we could get to the profitability. The most important thing is utilization is at a 5-quarter high at about 78.9%, if I'm right. So that's something that all the teams have been consistently working on. So that's also contributed to the margin gains that we saw.
Venkat, you want to add to wage hikes? How much, by when? And do you think, your company will need to either freeze hiring or perhaps even look at layoffs?
Just to put numbers in perspective, we had 150 people hired last quarter, and we have gone down on our headcount by 109. So you see, we had to hire. So it's almost kind of a reset of sorts, if you ask me. Like Joseph mentioned, the pyramid getting slightly shifted with the way markets are moving. So that's one side, and we have to also, handle the attrition of 18.2%. So it's actually counterintuitive. You have got companies talking about layoffs, and we are having an attrition of 18.2, which does speak about the kind of people that we have and the attention that they are getting from the markets in terms of opportunities. So we balance both of them. So I can make one statement: we're not looking at layoffs as such, but efficiency improvement levers. We are surely working on that. In keeping with all of this and the market trends, we will be looking at, compensation. Our annual increase is due this quarter, and we will be looking at it. And yes, obviously, that will have to be defrayed through revenue growth, some bit of luck on the foreign currency and the efficiency improvement that we talked about in utilization. So we have to do that, and we have to also keep the market trends. So we are looking at going ahead with our, increases this quarter. So we are working on that, and communication will be out to people very soon.
So wage hikes are intact?
Yes. No, I would say we are going ahead with the plan. The percentages are being worked out. If you look at the industry, nobody has made any commitments of any sorts. So in that kind of a background, there's quite a bit of assessment that's happening internally. What sort of increase that we have to do, and what are the segments that we have to look at. So all of that is in the works, Rima.
Needless to say, but hikes this year will be lower than last year, given the environment?
That would be a fair estimate.
Okay, that's an interesting chat. That's Happiest Minds talking about, of course, some of the generative AI revenues, etc. Some targets out there as well. Mitesh Thakkar is with us with what he'd want you to do as far as individual trades are concerned. Mitesh, welcome back. 10, 12 points, tentative right now. Market breadth looks better. 1,500 up, about 1,000 lower on the NSE. Your trades?
The market, has just been flat, kind of recovered from slightly from the intraday levels, but again, it's also off from the days. It's just a market which is still not giving any strong directional sense to me, so I would avoid the index in that sense. On the stock side, I have one buy and one sell call. Angel One, I think, that's a stock which gave a pullback yesterday to its 200 average, and today it started dropping below that level again. So keep a stop at 26.61 here and look for a short position and look at a price target of roughly around 25.50, 25.40 to begin with. Maybe slightly lower, but I think that's the primary target. And on the buying side, I have Amber. That's a buy with a stop below 7,800 and look for targets of around 8,100.
By the way, GNG Electronics and IndiCube, they have become the two latest entrants on the street. And look at the listing. GNG Electronics is flying 44%. Oh, that's a big one. They run the brand called Electronics Bazaar. They're in the business of refurbishing laptops, among other electronics. IndiCube is, of course, the co-working space management company. 9%, 7% down on that stock, but GNG Electronics is definitely electrified. New listings of the day. Speaking of primary market action, very soon we'll hear from NSDL. And it's a reasonably sized issue as well, over 4,000 crores. We have Vamakshi joining in to give us all the details of one of the key depository participants of India. Vamakshi.
Well, NSDL is set to hit the markets with a 4,011 crore IPO priced at 760 to 800 per share. It's a pure offer for sale, meaning no fresh funds for the company, only exits for existing shareholders. At the upper price band, NSDL will command a market cap of around 16,000 crore with listings slated exclusively on the Bombay Stock Exchange. So let's decode NSDL. Set up in 1996, it is India's very first securities depository and remains the largest. It oversees the highest number of issuers, active instruments, and total asset value under custody. Think of it as a bank, but for your securities, your stocks, bonds, mutual funds, and more, all safely held in demat form. The business goes beyond the depository. NSDL runs two wholly owned subsidiaries. NSDL Database Management Limited delivers e-governance and tech solutions from SEZ Online, insurance repository to digital onboarding. NSDL Payments Bank Limited offers digital banking, prepaid cards, merchant acquisition, and third-party product distribution. But NSDL doesn't operate in isolation. It's locked in a duopoly with CDSL. The differentiator, NSDL leans on institutions and unlisted companies, while CDSL thrives on India's booming retail wave. The numbers tell the story as well. In FY25, NSDL reported a revenue of 1,420 crore, growing at an 18% CAGR since FY23, yet the margins lagged 26.4% with profits at 343 crores and an ROE of almost 17.1%. CDSL, on the other hand, with a smaller revenue base of 1,082 crores, delivered 572 crores in net profit, a margin of 57.7% and a stellar ROE of 29.9%. And valuations reflect this trade-off. At 47 times FY25 earnings, NSDL comes in at a 24% discount to CSDL's 61 times. But who's cashing in? Legacy investors. IDBI Bank alone will take home 1,778 crores, NSE 1,440 crores, SBI 320 crores, HDFC Bank 161 crores, and Union Bank 40 crores. For some like IDBI and SBI, returns stretch up to almost 400 times. But don't mistake this for a total exit. Post-IPO, IDBI and NSE will each still hold around 15%, with SBI, HDFC Bank and Union Bank retaining meaningful stakes. They're booking gains, but yet keeping their skin firmly in the game. And to wrap it up, NSDL is a story of steady growth with leaner profitability reflected in its current valuation discount to CDSL.
Okay, all right. Very, very interesting primer as far as the NSDL issue is concerned. I mean, the issue closes, I think, on the 1st of August. It's open for subscription today. Vamakshi, thanks very much for that. We'll take a quick commercial break here. Manisha joining us on the other side. Commodities in focus. Manisha.
Welcome back. Well, the equity market has been more or less flat. Let's look at cues coming in from the commodity space. Manisha is joining in with the latest. Over to you, Manisha.
Thank you for that, Subhi. Well, commodities are buzzing, and it's not just the crude oil prices that gained up by 3% overnight. It has been the case with the cross metals as well. But I want to put focus on the ferrous metals, steel and iron ore, that is, because we are trading at multi-month highs into both of these. Well, we have seen gains on improving macroeconomic backdrop is the reason you're looking at steel prices holding firm, and we are trading at a 4-month highs at this point in time. Also, when you look at the prices itself, on a week-on-week basis, the Chinese steel prices have gained up by 3%. For the month of July, we are up by 9%. But it is the US steel prices which seem to be outperforming, and that is because you have a 50% tariff on import of steel within US, and is the reason you've seen US steel prices gain up by 20% in this year until now. Well, apart from US steel tariffs, it also has to do with China, which really seems to be pushing quite a mite. The policymakers are looking to reform the industrial policy. That has been supportive. China is looking to erase overcapacity in construction inputs especially. And then China crude steel production, when you look at for the month of June, also has seen a decline. That seems to be supporting prices. Bao Steel also says that they're expecting national output to decline by 50 million tons for 2025. So everywhere that you look, whether it's about cutting capacity to declining steel production, the month of May and then June also has seen a decline. And then guidance coming in for 2025 also has been on the weaker side. China also looking at that immense spent on the hydroelectric dam is also expected to lead to metal prices and metal demand gaining, and that has been supportive too. And then it's also about iron ore prices, which also are trading at around 4-month highs. Interesting statement coming in from Chinese Premier Xi Jinping, who's criticized local governments for concentrating investment in AIs, EVs and computing power and losing it all when it comes to infrastructure, construction, housing and real estate. And that is where the problem really seems to be coming in from. Apart from that, it was also about the Politburo meeting, which is underway right now. And some statement from China could really be supportive. And markets also are looking at the US and China trade talks, where we are hearing reading statements on how there could be a more longer breakthrough there. Markets are expecting China's stimulus measures to come in, and that really could be supportive. If you look at the iron ore prices for the month of July, then we've seen the Chinese prices gain up by 13%, while the US markets are up 5% as well. So ferrous, non-ferrous, all of those metals really surging, and the month of July has been quite positive.
Absolutely, and hopes ground that trade negotiations will turn out favorable between US and China. Thanks for that, Manisha. We do have to take a very quick break. When we come back, Lata will be in conversation with Rajneesh Karnatak of Bank of India to talk about the bank's Q1 performance.
Welcome back to our earnings analysis. Bank of India's first quarter numbers was impressive for the very minor fall in net interest margins, just 6 basis compared to 25, 35 that others have reported. It's also a fairly decent 32% rise in net profit. But the bank's cost to income has risen quite sharply from quarter ago, from the fourth quarter. For more, we are joined by Mr. Rajneesh Karnatak, the Managing Director and CEO at Bank of India. Good morning, Mr. Karnatak. Thank you very much indeed for your time. Well, first up, if you can take us through this margins picture. It's not fallen much, but at 2.5, 2.55, you're already lowest among banks. You're saying you will bottom out this quarter? You don't expect Q2 margins to be lower than Q1?
Yeah, thank you, Lataji. Thank you for having me here. First of all, as far as the margins are concerned, I would say that yes, we have bottomed out at 2.55%. If you see, it has come down by 6 basis points on a sequential basis from 2.61 to 2.55. At the backdrop, it is the net interest income which has come down. So if you see the net interest income, our interest income has gone up by around 8% and our interest expenses have come down. It has gone up by in fact more than 15%. So the net interest income there is a minus of 3%. However, having said that, I would say that we have the net interest income is flat at around 6,000 crores. So it is bottomed out in this quarter. We are saying this because of the fact that the repo rate impact, whichever is there, which we have already taken. So 1% repo rate cut, 60% of our loan book is the repo book, which has already been repriced.
No, 1 minute, sir. 1 minute. Mr. Karnataka, just a minute, sir. You know, the second rate cut came in June. Could you pass? I mean, your EBLR, external benchmark linked, is quite big. It's 59% of your book. So it won't impact on your returns in Q2?
So in Q1, the first cut had come 25 basis point in February. The second cut of 25 basis point came in the month of April, and the next 50 basis point cut came in the month of June. You are very right that the last 50% 0.50 cut has come in the month of June itself. But nonetheless, even 50 basis point cut, which the full impact has been taken in the Q1 quarter, normally 25 basis cut impacts the net interest margins by around 7 to 10 basis point. So 50 basis point cut impact was there for the full quarter of Q1. So that is what is the point that I would like to make. And on the liability side, the repricing takes some time. There is a lag in the repricing on the liability side. So we have already cut our saving deposit rates. We have already cut the fixed deposit rates. But the final impact on the liability side, on the interest expenses side, would be happening in the Q3 and Q4 quarter. So that is why we are saying that the stabilization of the NIM should be there from Q3, Q4 quarter onwards. And we feel that this 2.55 is bottomed out for us.
Okay. So, you know, most of your peers, like, you know, even smaller banks like UCO or larger banks like BOB, are all managing at least 2.9, 2.95 in terms of margins. What holds back Bank of India? Will you aspire to those higher margins anytime soon?
Oh, yes. If you see our book, there are two parts in that, Lataji. One part is with respect to our global book. If you see, 15% of that global book is the international book. So whichever bank has a significant international book also, their global NIMs are compressed on a lower side. So that is one of the basic reasons why our global NIM is 2.5. If I give you a color on the domestic NIM, there our domestic net interest margin is somewhere around 3%. In fact, it is around 2.9% at around our domestic NIM also. So because of the international book, the global NIM comes down. But nonetheless, we are very confident with the coming quarters, the NIMs should improve.
Okay. Well, let me come to the slippages. It's a very impressive number. Your credit cost at 68 basis is absolutely not a problem. But if I look at your SMA2, it's a little worrying. It has risen to about 4,400 crores, almost 3 times what it was a year ago. SMA2 means, you know, you're just a few days away from NPA. Should we worry that NPA can rise in Q2?
Yeah. So if I give you a color on the SMA book, you are right that in the corporate book, particularly the SMA2 book has gone up. So the SMA 0, which was there in June 24, has now gone to the SMA2 number in the corporate book as far as that is concerned. So majority of the SMA2 book is there, which is the corporate book. And these are predominantly 3 or 4 state public sector accounts, which are under the SMA2. But the present understanding that we have, these are all consortium accounts. None of them is a sole banking account. And the present understanding that we have is they should not be slipping into the NPA category. They should continue to remain in SMA2 or roll backwards in the coming quarters.
Okay, that's good to hear. The only other thing that we had about, doubt we had about your asset quality is that there are not enough upgrades and the write-off is a bit too much. Will that change? Will we be able to see more recoveries and fewer write-backs, fewer write-offs?
Yeah, so if I tell you the bigger picture which is there, in March 25, we had a gross cash recovery of nearly 9,500 crores.
Yes.
This year also we are targeting the same run rate of gross cash recovery of around 9,500 crores. And this does not include any write-off. So any write-off which is excluding that. So with that kind of number, and this quarter also, our gross cash recovery was more than 2,000 crores. In fact, our reduction in the NPA book, if you see in the outstanding, is more than 4,000 crore. 2,400 crore contributing through write-off and 2,100 crore is the gross cash recovery, which is more than the fresh slippages which have happened. In fact, equaling to the fresh slippages. So gross cash recovery should be at the same run rate of around 9,500 crores in this financial year also.
Okay, and my final worry was on MSMEs. Would you worry that your growth of MSME loan book has been fairly robust? It is in high teens. Will there be more slippages in that? Is there any sign? Because I think in SMA2 you are indicating that SMEs are there. There is a worry, but the bigger worry is in corporate SMA2.
Yeah. So as I said, at the cost of repetition, I would say that we are not much worried about the SMA2.
Yeah, I got that. Yeah, they are state institutions.
Correct.
But MSMEs,
correct.
Would you worry?
Yeah, so as regards MSME is concerned, you are right that we have grown on a YOY basis by more than 17% in the MSME book. However, the collection efficiency got impacted in the MSME book in this quarter, definitely. And if you see our fresh slippages of around 2,000 crore, nearly 30% of that slippage came from the MSME book. To give you a further deep dive into that, I would say that MSMEs up to 20 lakhs were the slippages, maximum slippages where it is happening. So it is the small ticket MSME book where the slippages are happening. That is a bit worry for us. And for that, we have improved our collection efficiencies and more of monitoring is taking place. And some guardrails also we are placing as far as the underwriting is concerned. And going forward with the busy quarters happening in September, December, we feel that this fresh slippages in the MSME should also come down in the ensuing quarters.
That's very good to hear, sir. Thank you very much, Mr. Karnatak, for joining us. The street is clearly noticing what you have said about the SMA2 book, as well as your NIM forecast that you've bottomed out and the stock is up 2.8%. From banks, let us move to a very important stock which is on the move today, and that's Tata Motors. It is a loser today. Talks have emerged on a potential Tata Motors Iveco deal. Parikshit, our stock correspondent, is joining us for more on that potential deal. Parikshit, what have you picked up?
Well, Tata Motors has been in talk with Italy's Iveco Group for several months now. This is to acquire a large stake in their commercial vehicle business. Now, what we learned from sources that both companies could announce the stake sale today, and Tata Motors will acquire the Agnelli family's 27% stake in the Italian truck manufacturer. And this could significantly enhance the presence of Tata Motors in the European market. This would be one of the largest acquisitions ever for Tata Motors. It is estimated to be around $4.5 billion. This is what we're picking up. So this would be a big move for Tata Motors at a time when their demerger process is also on. Hopefully, this will give them more access to European markets. And with the FTA, they could benefit as well.
Okay. Thank you very much for that very important nugget. At the moment, Tata Motors, I guess, is worrying because there will obviously be a debt addition because of this, and probably memories of previous acquisitions are not very pleasant even for Tata Steel. But, well, this time it could be different. Tata Motors a little under the weather because of this news. We have to wrap up on Bazaar on that note. Chartbusters after the break.